Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to estimated financing needed for an increase in assets. In other words, we're going to have an increase in the assets and estimate what kind of financing we may need, what kind of debt we might need to take out in order to increase those assets. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into the worksheet on the right-hand side. We currently have 2 tabs in our worksheet. If you have an Excel worksheet you're working with, you might have 4 tabs, 2 with the answer keys on it, 2 with the practice problems. So we're going to be looking at the practice problems tab, including practice 1, practice 2, 2 similar layouts, but different numbers. We're going to be on practice tab 1 here, and then we're going to have our information up top. We're going to say that the expected sales are going to be the 500,000. And then we're going to say that there's going to be an increase in the assets. We believe that the expected increase in inventory and accounts receivable will result as well. So we have a sales increase. We're going to have an increase in the assets of 85,000. And then we want to think about what's going to be needed, or if any financing will be needed. Our profit margin is going to be 16%, and then we've got 40% that's going to be paid out in the form of dividends. So how much added financing will be needed if this is the case? Do we need any added financing? How much if so? So we're going to assume that there's no increase in the liabilities other than the amount related to the external financing. So meaning the amount that we're going to take out if we need a loan for this amount here. So we're going to say, all right, we'll start off with basically an income statement. Then we'll calculate the dividends that are going to be paid out, and that'll give us our increase in the retained earnings. And then once we figure the increase, we'll think about whether or not any more financing will be needed. So we're going to start out up top. We're going to say, all right, the expected sales, let's just say that this is going to be equal to the sales number. We then have the profit margin. So that's going to allow us to jump down to what we're going to receive on the sales or our return. So the expected sales, 500,000, the profit margin being the 16%. Let's go ahead and percentify that. Home tab. Let's go to the numbers group and make it a percent. Let's go to the home tab, font and underline. That's going to then give us our net income. So net income, if we multiply this out, then is going to be equal to the 500,000 times the 16%. We're going to have the 80,000 of the net income. So 80,000 of the net income. And so now we're thinking about, once again, how we're going to finance what we believe there's going to be an increase necessary for that 80,000, or an increase in things like receivable and inventory to get to that 80,000 of 85,000. So how are we going to finance that? Notice the net income is a little lower already than the increase in the assets. And then we also have the fact that we're going to be paying out dividends. So we've got dividends that we're going to need to pay out. So if I take this net income then, and then we figure the net income is 80%, and we pay out dividends typically at the 40% of the earnings. So now I'm going to say we're going to be paying out 40% of the earnings. I'm going to make this a percent, go into the home tab, numbers, percentifying it, home tab, font, and underline it. This will then give us our dividends, and we'll multiply this out. This will be equal to the 80,000 times the 40%. 80,000 times the 40%, giving us the 32,000. So we have the net income minus the dividends is going to give us the increase in retained earnings, the earnings that we are retaining. So we're going to say we've retained the earnings. This is going to be equal to the 80,000 minus the dividends we're going to be paying out. That means that there's going to be a net increase in basically equity. So that's going to be part of the financing. So when we think about the increase in the assets, we're going to finance it in part with the equity here, and the other portion with liabilities. So now we're going to have the increase in assets. We said there's going to be an increase in assets of the 85,000. How are we going to finance that? Well, we have the increase in the equity, which we can finance by the 48,000, and then we're going to need the extra funds that are going to be needed then in this scenario would be then equal to the 85,000 minus the 48,000, or the 37,000. Let's put an underline here, home tab, font group, and underline. Notice we're basically looking at, you can think about this as basically the accounting equation here. We got assets equal liabilities and equity. Assets equal liabilities plus equity. And we're thinking about the fact that we think that the assets are going to be increasing by the 85,000. And how are we going to finance that? Well, we have the equity, but the equity was 80,000, and then we're going to be paying out 40% in the dividends for it. So that means that the equity portion that's going to be financing that increase of 85,000 assets is only the 48,000. And that means the liabilities has to be the difference, right? So if this assets are going to go up by the 85,000 and we only finance 48,000 of it with equity, then the liabilities are going to be needed in order to take up the difference. Now let's work that again, just keeping this equation kind of in mind. If I go back on over here and say, let's work this again and just put our accounting equation up top this time. And once again, we're going to say that the assets we think are going to be increasing by the 420. If that's going to be the increase, how are we going to finance it with liabilities or equity, right? So we're going to do the same kind of scenario. We'll say, all right, well then the expected sales, say this is going to be equal to the expected sales of the 3 million. So we'll pick up the 3 million. Then we're going to pick up the profit margin. So the profit margin, and that's going to be the 22%. This will be the 22%. I'm going to make that a percent, home tab, numbers, percentifying it and underline it, home tab, font group, and underline. That's going to give us our net income. So we'll say net income is going to be equal to the 3 million times the 22%, and that's going to give us our 660,000. So that's going to be our increase. So you'd say, okay, well, equity would be increasing by the 660,000, which would be fine to finance the assets, but not the case because we're going to pay out some of it in dividends, and we're going to pay off a pretty high amount, which is 45%, which is what we typically pay out. So we're going to say, all right, of that net income of the 660, we're going to be paying out the dividends at 45%. I'm going to say this equals the 45%. I'm going to make this a percent, home tab, numbers, percentifying it, home tab, font, and underline it. This then giving us the dividends, this being equal to the 660 times the 45%. That gives us the 297,000. So then we're going to say, all right, then the increase in the retained earnings is not just going to be the net income. It's going to be equal to the net income minus what we're going to have to pay out in dividends. And that means we have the 363,000. So that's going to be what our equity basically is, right? The 363. And so now we got to figure out what's going to be the external funds that are going to be needed. And we could say, all right, well then now that means that we have the increase in assets. Let's just call it increase in assets, which is going to be equal to that 420 as a result of this. And we're going to say then that we're going to finance that in part with the increase in equity, which is the 336. But that's not going to be enough. We're going to need external funds that will be needed in this scenario equal to the 420 minus the 363 or the 57,000. Let's put an underline here, home tab, font group, and underline. And that's going to be our liabilities that we basically need so that we can finance. There's the 420, the increase in the assets with liabilities and equity.